Hey everybody, this is Bo Yoder here. I wanted to put together a quick little video for you to talk about microstructure and the profit power that most people don't even see in the market, and what I call microstructure within individual bars. So you see here on a 5-minute chart, I've highlighted a little area here after a reversal in the stock of Apple. Without going into a lot of detail, this is a reversal pattern based on a disconnect between pricing and power. So this is our proprietary 3D Apex power indicator, and that's going to give us a lot of insight onto whether a particular move is sponsored or not by the market. So you can see here, as the market moves lower, power is decreasing. That's really the only thing that matters in this case. That sets up a potential reversal trade back up towards areas of resistance. In this form, we've got the orange line, which is our 50-period simple moving average, and we've also got chart resistance from this high and this high as well. All right, now let me just go ahead and just kind of draw that out so that's real obvious for you. Okay, so if this is indeed a market reversal, very likely that was going to test the next resistance level, which would have been that point. Okay, so very traditional trading, right? You got a reversal, you would have probably bought above this bar's high, and you would have taken your profits into this zone. Real straightforward trade. Some may call this a scalp trade. Some may call this a swing trade. Again, there's a lot of jargon within the trading world that can get people confused. But I would call this a short-term directional trade. For me, the definition of a scalp trade is a trade in which you're not willing to hold a wiggle. So this actually would define as a scalp. You bought it here, you sold it there, there weren't any significant corrections, so it was pretty much a one-way street, right? Dream scenario for any trader. But what I want to show you is how much money you're leaving on the table if you don't understand the value of trading as a liquidity provider. All right, so let's go ahead and draw another box and just encapsulate the entry and the exit for this directional trader. And now let's go down and look at, in smaller time frames, what it is we were seeing here. Now remember, the concept of this trade was, at this point, it had proven itself as a reversal, and it was going to rally up at least to the resistance level, if not beyond. That would have been the odds picture going into this trade. Let's go down to the 1-minute chart and look at the microstructure surrounding this move. Okay? Look at how many red bars and green bars there are, up and down throughout this zone. Okay, so now what I want to show you is what would have happened, since basically at this point you considered this a buy, and for most traditional trading programs you would have your stop under the low. So your risk envelope really, actually let me draw this, or let me shrink down this first box to just show the risk. Okay, so your risk envelope is the bigger box at the bottom. Your profit envelope is the other box at the top. You're looking at a little more than a 1-to-1 trade, a little more than a double your money kind of a trade, right? You put $1,000 at risk here, you're going to get $1,000 back out if that profit target is reached, and obviously it was. Okay, so that's your odds picture, that if the market breaks above this point, it's likely to go to this point. So now let's go ahead and just look at all of the movement within. And just to make this real simple, I'm going to arbitrarily look at these vertical lines here. I'm sorry, the horizontal lines here, which are looks like every 40 pips, or 40 cents rather. So what I'm talking about here is what I would call a cloud, a liquidity zone, or a bid ladder approach. So anytime the market's coming in, again, let's think about this logically. If I believe that the odds are extremely high that the market is going to go from this point down here to the top of that box, this point up here, and I feel like the odds of that happening are very, very high, then anytime the market jinks back down lower, it could be said that the market is cheaper, right? So again, there are some filters that we use that we talk about in other videos and other lessons. But so let's not talk about that right now, because those filters are a way to increase your odds. I just want to get you into the concept of microstructure. So let's say you just had a standing bid in here at 495.60. Okay, so you buy it at 60, you sell it, you make 40 cents. It comes back in. See how it got below that level again? Well, if you were bidding in that market, you bought it again. And sure enough, it went back up to these highs. You sold it again. Now you've made 80 cents. Came back in. You bought it again. You sold it again. Came back in. It looked like it missed just a little bit. And then it pushed back up. All right, so now let's say you're following this. So you made 80 cents on that move. Now you're coming back in. You're buying 496 even. So you buy 496. You sell 496.40. rallies up, comes back in. Now you've ratcheted things up. You're buying 496.40. You sell it again. So now we're up to $1.60 in profit. So you see that all of these little microcycles are chances for very, very high probability liquidity cycles, buy and sells in a very short period of time for a very small amount of risk. So now what is different in this risk picture? Well, let's talk about this for a moment. If you buy in the traditional manner down here at the setup on, what was that, the 15-minute chart, or the 5-minute chart rather, and you expect the market to go up here, you have a high odds scenario, right? I mean, sooner or later, the odds are good that it's going to come up and hit your target price. But in that time, there's a lot of time risk. Things can happen. News can come out in the market. The phases can shift. There can be more supply that might come in and change this marketplace. And really, the only way for this trade to win is if other people agree with your market opinion and come in and buy up that market, pushing it to the upside. Well, now if you're a liquidity provider, yeah, you've got all those forces in effect, but you're going in and you're buying it a little bit cheaper than everybody else, and then you're selling it to them a little bit more expensive. Because people in the marketplace are not aggressive. They tend to be very fear-based and very conservative. They love to jump on a train after it's left the station when the risk is actually very, very high. And so what we want to do is feed that liquidity. We want to offer them a chance to buy from us at a small, reasonable, reliable profit as they look at the market with bigger expectations. And why is that? Well, number one, there's a very good chance that you can flip enough of these little transactions as the market goes from here to there to actually make more money than an initial outright purchase. Second, and more importantly for me personally with my own trading account, is that the amount of risk that you're taking on is very, very small. Because as the market pulls back in, you're basically flowing with the money flow. I mean, look at this market. Look how smoothly and powerfully it moved to the upside. And actually, if I go back to that 5-minute chart where this setup was based, you can see the power indicators just showing tons and tons of order flow coming into this market. So the odds are really good that the market's going to continue to rise. So anytime that market has a microcycle and comes back down and hits you on the bid, chances are very, very, very high that you can flip that out very quickly for a nice little tidy profit. So does that make sense? I hope that crystallizes it for some people. Again, there are some extra filters you can place on this concept which will increase your reliability and your accuracy, but that's not really the core here. The core is that you're buying and selling within the microcycles in the market. Because even though the market may have only gone up, let's say $5 from here to there, the travel that it experiences as it goes from here to there could be 10, 15, or 20 points of movement. And that movement equals profit potential. And that's really what I want you to get out of this is when you're trading as a liquidity provider, each one of those little microcycles can offer you the chance to bang out a little profit. And to my way of thinking, I'd rather make 10 trades with very small amounts of risk and very high probabilities for success than one trade with a big profit opportunity and a moderate chance of success. Because as you all know, having gone through some of our training, the compound wealth effect is a big part of our long-term planning and our goal setting. So if I can make consistent profits, I can compound that money very, very quickly into a significant sum. If I hold out for the big win, if I chase the money, if I try to trade moves rather than odds, then I'm really just waiting for that big hit in order to move my account forward, rather than moving it forward a little bit each and every time that I go into the market to try to trade. So there's a good example of the microcycles within the liquidity provider trading formula. Hope that makes a little more clarity for you. As always, I'm always interested in your questions. Go ahead and leave a comment on the blog or in an email to info@3dapextrading.com. Be happy to answer questions and help you understand a little bit more about this way of approaching the market, because it really does change everything for you, and I really want you to get it because it's going to be a great thing for you and your stress levels as a trader. So, with that, thanks as always for listening. My name's Bo Yoder. Good luck and good trading.